take action, because if you don't take action, it's not really going to help you.
Profoundly said, Scott.
It's so true.
Good afternoon, Scott.
Hello.
We literally just finished recording an episode about why we really need to think about life and yourself as a human and emotions and values and how that needs to be at the center of all your financial planning decisions. And now this episode, we were actually casting about for like a life planning lens through which to describe this. I'm like, I don't know if I can. This just seems like straight up tax optimization. And the topic is Roth conversions.
Yes. People ask about them all the time. Great time to talk about what they are and how to do them and when you might want to think about doing them.
And when's a bad time to do them, most likely.
Exactly.
All right. So how would you describe what a Roth conversion is, just to sort of define the necessary vocabulary?
So a Roth conversion is taking money that is pre-tax, could be in your 401k at work, or it could be in an individual retirement account at some brokerage. And you're saying, hey, I want to take some of this money and I want to move it from my pre-tax buckets into an after-tax bucket. So I want to go from the 401k to a Roth 401k, or I want to go from my IRA to a Roth IRA. Mm-hmm. And when we do that, that will create taxable income.
Right. Because when you put the money into the pre-tax account, you got, let's say you put $10,000 in, you got to subtract $10,000 from your taxable income. And now that you're moving it out into a Roth account, you're adding that $10,000 back into your income.
Absolutely. So that's really what a Roth conversion is.
Right. So you are choosing voluntarily to actually incur more taxes this year.
That sounds crazy.
Why would you do that? Well, I think the most obvious and the easiest to understand explanation is that when we were talking about taxes, everyone wants to pay less in taxes. Cool. Got it. I actually have one client who doesn't care about reducing his taxes, and that's very much a sort of a political, moral stance. But the vast majority of us, if we can legally pay fewer taxes, all else equal, we will absolutely do that.
Absolutely.
But most of us tend to think about, how do we minimize taxes this year? How do I pay less in taxes right now?
Right.
And our perspective as a financial planner is, let's broaden that. And the goal should be, how can you pay less in taxes in total over the course of your life? And sometimes people even get into like subsequent generations.
Yes.
I'll just cut it off at your death in this conversation.
Good enough for today. But focusing on your lifetime, to your point, because that you're 100%, the normal frame is like, especially with an accountant too, is like, because that's, they love showing people ways to save money in taxes this year. And that's always lovely. But to your point, like, well, let's look at this year. This year matters, but let's look at over the course of our lifetime.
Right.
And how can we save?
Right. Because if you could pay $10,000 extra in taxes now, but know that you'll save $100,000 over the next 20 years or whatever, I'm just making up these numbers. Obviously, that's a good trade-off to make, even though it means you're paying more in taxes this year. So how would that work? Well, it would work if your tax rate this year is lower than your tax rate in the future.
Yeah.
Right. So that's in a way, it's very simple math.
Yeah.
It's extremely hard because we never actually know what our tax rate in the future will be. We know this year's tax rate. We can't know the future tax rate. We make our best guess about future tax rates.
Yeah, that's one of those where simple doesn't equal easy, because knowing your future tax rate, not easy.
Yeah. Not even possible, really, but we can make our best guess. And then there are some, I think, less obvious reasons that you would do a Roth conversion that probably only your favorite neighborhood financial planner is ever going to talk about.
Right.
Because they get pretty nuanced, pretty nerdy. One of them is a little bit of background. If you have a pre-tax 401k or a pre-tax IRA, when you turn, at this point, I think for me, it's age 75,
Right. For
When I
the
turn
younger
75,
generation,
I have to
75
start
now.
taking money out of
Yeah.
my IRA and paying taxes on it.
Yeah. So that's called a required minimum distribution.
Yeah.
We'll call it an RMD in our space, is what you'll see it in articles that you'll read. All that it means is you're going to have a balance December 31st, and the IRS is going to tell you a factor that you have to divide that balance by. And that's what you have to take out that year.
Right. Because
And you don't have you just have to do it.
Because they want their taxes at some point.
Yeah, they want their
didn't
money
get it
back.
at the front end.
Yeah.
Roth accounts don't have an RMD.
No.
Federal government already got their taxes.
So they're happy.
Yeah. So for some people, it can be very helpful to lower that required minimum distribution.
Yes.
There are also all sorts of, when you get into like hardcore nerdy retirement planning, which honestly I don't do for my clients because they're not in retirement, but I know enough to know that hardcore nerdy planning exists. The interaction of all sorts of different income sources is tremendously complicated. You have money, maybe you have it from a pension, probably not for anyone I work with. Maybe you have it from an annuity. Then you've got, investment income from your taxable investments. You've got RMDs from your IRAs. You eventually have Social Security. How much income you have in total and from each of those sources can determine your tax rate. And so
absolutely,
if you have money in a Roth account, that's not taxable income when you take it out.
Right.
So it allows you to more accurately tune your taxable income, which can have benefits like less of your Social Security income is subject to tax. Your Medicare Part B and Part D premiums are lower.
Bringing up IRMA. Look at you. You're not even a retiree kind of person, and you're bringing up IRMA.
Yes. Although note I did not call it IRMA because I don't even know what that stands for. Anyways, my point though is being able to tune the level of your taxable income by having money in a taxable account you can live on, money in a pre-tax account, and money in a tax-free account. Super helpful. Okay, I am going to go back on something I said earlier when I was saying, like, we're just going to think about this in your lifetime. I want to violate that rule for a second, which is your heirs would whether they know it or not, they would much rather inherit Roth money than pre-tax money because they too get to take it out tax-free. And
so if you think of it simply for like the average American, like you're going to have an IRA account and you're going to have some number of income, I don't know, $20, $30, $40, $50,000 a year going through that income. And if it's a family filing jointly with Social Security and all those things, you're going to be in a fairly low tax bracket, more than likely, or you'll be able to manage your tax bracket. But if it goes to the next generation who's still working in their highest earning years, they only have 10 years to take that money out. So they basically have to take that money out and get taxed at the highest rates. So what you can look to do is you can look to do planning, not only for yourself, but also for the next generation. Now, if the next generation isn't earning a whole tremendous amount, it's not a big deal. But if they are in the higher earnings, which like for folks in tech and biotech, your kids will probably be in similar style careers. It makes it so they will be in very high end careers as well. And then they will be potentially paying the highest tax brackets on your inheritance, their inheritance.
And then the last thing, and I haven't seen a lot of discussion about this, but this is actually one of the reasons I'm not doing Roth conversions right now, but I actually am saving to my 401k into the Roth 401k. So I'm choosing that over getting a tax deduction. Is that if we harken back to just a few minutes ago when we said we cannot know our future tax rates, uncertainty is really hard to plan around.
Yeah.
Well, you know what? If I save Roth or if I do Roth conversions, I know exactly what my tax rate on that money will be in the future.
Yeah,
it's going to be zero.
Yeah.
And there is just real reassurance, real comfort to me in knowing that that is something that is in fact certain, not uncertain. And I can do a lot more confident planning.
If you're in the highest of tax brackets in the land, it might make sense to still do pre-tax for some of those assets, but there's others that you could do backdoor Roth IRAs or mega backdoor Roths. We can do an episode on in the future, just explain those a little bit more. But yeah, if you're in these higher income years and then you're in a year where it's like, do I do a conversion? Do I do it this year? I'm in a high income year. Like, what's the mindset there?
Yeah, I think there are, certainly when we work with our clients, we're always on the lookout for, are there circumstances in this client's life that would suggest that this might be a good year to do a Roth conversion? pretty much the biggest thing I'm looking for is this an unusually low income year for them?
Right.
And I regularly have one or two clients who are in a sort of anomalously low income and therefore low tax rate year. They've taken a sabbatical. They got laid off and had a really hard time finding a job, a second job. They've gone back to school. They're not earning. They're in fact spending lots of money.
Mm-hmm.
Years ago, I think I mentioned this in a recent episode, we recorded sort of a missed opportunity for me when I started this firm and had like $0 of income. That would have been a great opportunity to do a Roth conversion.
Perfect.
Just wasn't thinking about it.
Yeah.
But there are good reasons and bad reasons that you might have a low income year. But regardless of the goodness or the badness, the silver lining at least can be, you could shift some of your money at sort of a cheap tax bill over into this forevermore tax-free bucket.
Yeah. Agreed. Yeah. So that's to your point. When people are on sabbatical or a job loss occurs and, they have plenty of cash and liquidity in other places, it's a lovely time to be doing Roth conversions. It's kind of when life gives you lemons, make lemonade, right? Sometimes that's a lovely thing to do. And then hopefully it is a nice thing like sabbatical or something like that that's happening where you're just going to have lower income that year. But yeah, absolutely. Those are common places we see Roth conversions. The other would be when people are retired, but they have not yet turned on things like Social Security, or if they had a pension, other things. So they're probably living off of taxable investments, money that's in a brokerage account. And you have the ability to choose to manage your tax rate. And you're looking at how do I float myself up to the higher ends of these specific tax rates in the hopes that it lowers my overall tax bill throughout my lifetime.
Yes. If you happen to ever work with a retirement financial planner, you will almost certainly see like the classic graph that shows you your tax rate associated with your income without Roth conversions. And then there's this sort of hole in the middle of the graph. And the x-axis is like your age. There's this hole from age like 65 to 70. You've retired, you stopped earning income.
Yep.
But you haven't claimed Social Security yet. So you have no income and you can fill up that hole with income from Roth conversions. I just sort of chuckle that it's the same damn graph that I have seen 1,000 times. I mean, it's a good illustration.
It explains the opportunity, which is cool, but it's not, it's like everyone's doing it now. So you're not unique if you're doing that and you're listening. Yeah. No, totally. The thing you want to be careful of if you are of an age where you're still working, which maybe there's someone on here who's still working and collecting Social Security and you took that time off. There's this issue. I call it the middle finger because basically Social Security doesn't get taxed like dollar for dollar automatically. It comes into our tax brackets. So if you have a year when you have low income and you start doing a thing like a Roth conversion, you actually start taking some of your Social Security money and you start adding it back into your taxes. So it goes from thinking you'll be like, oh, I'm going to be in that 22% bracket, but in all actuality, you'll be like 37 because you're bringing in Social Security. So just be wary of that. You're a rare person listening to this podcast, but I have to tell you anyway.
Right. I think it's really interesting to me as sort of an observer of the profession or the industry, because that time frame, that sort of 65 to 70 after you retire before Social Security, that used to be, or probably still is, the time period that advisors talk about as the opportunity for Roth conversions.
Right.
And then more and more advisors are working with younger clients. We're like, well, that's great, but that's decades in the future.
Right.
And so we, began looking for what are the opportunities now? And it is those big life transitions where your income either lowers or disappears entirely.
Yeah. And the thought process would be, because that's kind of like when you think about doing it, anything else on that? Or when you think about I guess we talk about when not to do it too.
Yeah. There's one more thing on the when it might be a good idea for you. And it's this sort of general idea of when you think your tax rates are going to be higher in the future.
Yeah.
Right. And that's a combination of your personal financial situation and your expectations about what the government's going to do.
Right.
Now, I really caution against any sort of glib, simplistic, oh, have you seen the national debt? We're totally going to have to raise tax rates. So
Oh,
tax rates must go up in the future.
I thought you were going to tell us what tax rates are going to be in 2026.
Sorry.
How do you not know that already?
I can't even tell you like a year and 2 months from now, let alone 20 years from now. So there's that. And, there is an entire graveyard of failed projections of future tax rates out there. But there's also the idea of, well, what will my personal tax situation be? And I say this because I live in a no income tax state. And it's very possible that I will move to a state where there is a state income tax. And so, in such states, not all of them, and in fact, some states have an income tax, but they don't tax distributions from IRAs. I think Illinois and Pennsylvania don't tax distributions from IRAs, for example.
Are you sure you're not a retirement planner?
Just really big brain, Scott.
It's like all in there still. It's amazing.
But just the idea of, there are a lot of states most states out there have a higher tax rate than the one I'm living in now.
Absolutely.
Right. So it's a little bit of insurance of, well, shoot, am I going to move to California? Because they've got a really high income tax. If I convert it to Roth, I don't care from that perspective.
Absolutely. What about when we should avoid doing it?
This is the topic I think about multiple times a year because we ask ourselves this question about every client every year, basically.
Mm-hmm.
And one of the most sort of interesting aha moments I had was for a client, a couple. They both went through an IPO, so they're got a lot of money out of that. So they've been taking a sabbatical for several years. So their income hasn't been that high.
Awesome.
And so from that perspective, it's like, ooh, maybe we should convert some pre-tax IRA money. But their intentions for that IRA money is actually just to give it to charity.
Yeah.
Right. So if your money in your IRA is going to go to charity, either at your death or, again, like fast forwarding to the year when you're 75 and you have to take those required minimum distributions. Right. If you would just direct those directly to a charity, there's going to be no tax impact to you anyways. So there's no value. There's negative value in fact doing that Roth conversion now. If that money is going to go, the IRA money is going to go to a charity in the future.
Yeah. And the little nuance on what Meg's speaking to is there's this rule within the tax code that says, hey, if you have pre-tax money, you're allowed to give up to $105,000 a year as a qualified charitable distribution. And that can qualify as your required minimum distribution. So if you're going to be under the $105,000 RMD limit in your IRAs, it would totally make sense to just keep it in there and let it keep growing and then just give it directly to charities. Because the other side of it, if you think about it for a second, you're like, okay, I'm going to give $100,000 to charity. And if I give it from the IRA, I don't have to pay any taxes. The charity receiving it gets more money. If instead I said, I'm going to send that in, but the IRS was like, well, you have to take that RMD first. Well, then I'm just going to make up a number. You're going to pay something like 30% to taxes and keep 70%. So now you have 70 grand to give. But it's like, so you just get to give more by giving directly from a pre-tax retirement account.
Yeah. And especially speaking to sort of the audience of my clients and like people, birds of a feather, this consideration is literally decades in the future. So it's sort of an intellectual rationalization, but still a useful one to sort of have on the checklist.
But also to that end, I'm also for when we build, working with clients, when we look at your balance sheet, I am all for flexibility. And what I mean by that is I wouldn't want to see someone go from having all IRA money to all Roth IRA money, right? Because we don't know what the future tax codes are going to be. But if we can get you so you have a decent amount in IRA money and a decent amount in Roth IRA money and a decent amount in taxable money, well, now there's so much flexibility for planning for how you're going to live when you retire, for planning for how you're going to give to other people or to charitable causes, and for how you're wanting to move assets to the next generation, should you have any left. So I think there's something to be said for having flexibility. So just wanted to bring that. hit my
Right.
brain
So
while we were
it's,
chatting.
yeah. And I think for the clients we work with, almost universally, they have way more money in pre-tax accounts than in Roth
Always.
accounts.
Yeah. So it's like you could be doing these conversions almost all the time, and you're rarely ever going to get to like 50-50 between the two.
Yeah. Other times when it probably doesn't make sense is just when like you have a normal or especially a high income year, right? Your tax rate isn't lower than normal. It might even be higher than normal. This is sort of the definition of when not to do this.
Yeah. And then the other one that comes to mind is like if you don't have liquidity to just, let's say you're on sabbatical, live life, one, but two, you don't have the money to pay the taxes that are going to come from doing this conversion. You really don't want to pay taxes from the conversion. Like you don't want to raise money from the conversion for the taxes, right? You really want to use money that's already sitting on your balance sheet somewhere else in a checking account or a taxable investment account to do this conversion. It just makes it so that the upside ends up coming sooner rather than later. And when I say upside, that's because this is a guess as to what future tax rates are going to be relative to tax rates today. And the bigger the discrepancy, the faster you close that gap. And if you don't pay out of that conversion amount, it helps you close that gap faster as well.
Yeah. And I think that also speaks to what you just said about having ample money in a taxable account, pre-tax account, and Roth account.
Yeah.
Here we're seeing one of the purposes of having money in this taxable account is that it actually enables you to do a Roth conversion sort of in the best way possible.
Yeah. Little caveats. It's not really revocable. Like once you do it, you can't really undo it. So make sure you really want to do it. There's just as a disclaimer. And then another little disclaimer is that when you do a conversion, the converted amount you do have to, in a sense, leave in the Roth IRA for 5 years before you do anything with it. You can always take the principal out, but the funds that grow above and beyond it. So you just want to make sure that you're not going to, you already should be okay with leaving the money alone.
I mean,
just
especially if you're 30 or 40.
It's already in your IRA account. It's for when you turn 75. But it's just good to know what the little rules are, because rules are rules, and we don't want to break them and get ourselves in trouble.
As you were just saying, like this isn't revocable, so you really want to be like as sure as possible. This is a good idea, which is why we're bringing it up now near the end of the year, because the closer to the end of the year you are, the more you know, the more certain you are about what your income is this year.
Yep, absolutely. And that's the other, so like if, this time of year, if this is piquing your interest, this is the time to like reach out to your accountant or reach out to your advisor. Be like, is this something I want to be doing this year? If you're having a low income year or you're taking that sabbatical, all those things. If you're going to take one next year, you start to be mindful about figuring out whether or not it's going to make sense next year too, I suppose.
I forgot one reason that might prompt you to make this a good year for the Roth conversion. Mm-hmm. If the stock market has dropped a lot, right?
Yeah.
If your pre-tax IRA used to be worth $100,000, stock market fell in half, now it's worth $50,000. Mm-hmm. You've sort of like compressed the value of your IRA because we expect it to recover.
Yeah, absolutely.
So I'm just going to convert the whole account for simplicity's purpose. But if you convert now, you're just paying taxes on $50,000. Sort of regardless of your normal income situation, this is a very different consideration. Yeah, you got to pay maybe a very, sort of highish tax rate on that $50,000, but it's only $50,000 as opposed to sort of the quote unquote normal $100,000.
Yes,
it just fell down from.
Yes, which gets back to the idea of why you want to be paying for this with outside money, outside the IRA, because ideally, to make it really simple for yourself, you're literally just reaching out to your custodian. If it's an IRA at say Vanguard or Schwab, or if it's your 401k provider at work and you're going to do an in-service conversion, you're just going to say, hey, can you just convert those shares from my pre-tax account to my Roth account? And you didn't even have to think about buying them back. Just automatically did it. And then it can come right back up. So that's a really good point. And to your point, the reason we do it toward the end of the year is because you know income. And to your point, you also know performance. I don't even know why I'm here actually today.
Yeah, I've written a blog post about this. So it's something like I've got an outline kind of in my head.
You're doing great. You're doing great.
Thank you.
Yeah. No points that I would take away. I think you've nailed them all. But I do think that look at where you want to do it. be it in your IRA or be it in your 401k. Ideally for you guys, because you've listened to the show, it will be in your 401k, so you can still do backdoor Roth conversions every year. Talk about that a different day.
All right. So if we wanted people to take one thing away, if we wanted them to do one single thing after listening to this.
If you think you might want to do this year, you got to reach out to your people and make sure they help you do it, or look how to do it yourself. But take action, because if you don't take action, it's not really going to help you.
Profoundly said, Scott.
It's so true.
Yeah, I mean, these opportunities really are bounded by the tax year, right? So December 31st comes and goes. Like, you've lost this year's opportunity.
Yeah, you don't want to do this the last week of December. That's just painful.
Yeah. So if all those circumstances under which we said, maybe it's a good idea to do a Roth conversion under these circumstances, you've got low income for this, that, or the other reason. If you're like, oh, that sounds like me. Yeah. Email your financial planner, advisor, whatever they're called. Email your accountant, CPA, EA, whatever they're called.
Yeah.
And just ask about this.
Absolutely. And if you like what we're doing here, please leave a review. That's how we know you like it. And that keeps us going. So we appreciate you. And if you want us to answer a question of yours, we would love to answer your questions. So please go to realpersonalfinance.co and leave your questions. And until next time.
All right. Bye, Scott.